Good evening, everybody. Okay, we're going to kind of give you a double doozy here tonight. I'm going to do about 15, 20 minutes of analyzing the market and which kind of trades are looking like they are the best trades to set up. Give you a couple option strategies, and then Mark Sebastian will come on right afterwards, and he will go into much more detail on some very efficient and very effective option strategies. So with that, here we go. Let me do a trend. We can see what was happening here in the Dow. Had this kind of wedge formation setting up. This is being recorded, yes. So we had this wedge formation, and it went from pushing the top side of that wedge on, what is today, 3 or 4 days ago, to slamming to the bottom, doing a doji, and making it a very simple analysis today. We know that the price or the things are usually going to move in the direction of how they open it after a doji. So when we woke up this morning and saw the pre-market futures were down 112 points, 117 points, we knew immediately the support level wasn't going to act as support anymore. So that told us that anything that was looking iffy on the long side probably should be closed out. Anything on the short side should probably be gone after. Now, the same scenario was kind of true on the NASDAQ, where the NASDAQ did a doji right here smack dab on the 50. And we saw it opening lower, told us the 50 wasn't going to act as support anymore. So even though during the day, or ending the day, we came up and closed near the higher end of the range, we're still down. That's still telling us investor sentiment has kind of gone to the negative side. Now, even though that's iffy, if we go back to the Dow, we've got two scenarios to look at. If this opens lower tomorrow, that's telling us we're probably heading down, a double doji sandwich. Which also tells us we're probably in a blue ice failure. And for those new here, a blue ice failure is where they fall through the ice. They come up, try to find the hole they fell through. In this case, they failed twice. They drowned. They go to the bottom of the pond, which in this case would be the support level at the 200. So if it opens lower tomorrow, we can pretty well analyze that they've finally broken out of this wedge. They're heading for the 200. On the other hand, if they open up positive, same scenario, we know that they're going to move it in the direction of how they open it after a doji. It means they're probably coming back up into this sideways trend, which is what we've been looking at now for the last 3 months. Basically sideways ever since mid-July. Took a drop, and then it moved sideways again for the next month and a half. So, as you can see, not only is the market moving sideways, but you can see on the charts, based upon the candlestick signals, you have an up day, a down day, an up day, a down day, a couple up days, a couple down days. So there was no way you could really get your teeth into a trade, because even if you had a good chart pattern, 2 days later it might be completely gone. So last couple of nights we've been kind of talking with people. They say, well, I don't know what the problem is. I've hitting good trades, but I can't make any money. The answer is it's hard to make money when the market is doing this. Why 200 support versus any other level? That's just the next major support level. Once it gets there, you see whether it's going to bounce but at least the target, if it breaks through this level right here, more than likely coming down to the 200. So, anyways, because of the doji rule, it's going to move in the direction of how they open it after doji. We'll have a pretty good idea which way they're taking it. Now, if they take it up, that doesn't necessarily mean we're in a bullish market. All that means is we're probably right back into this sideways trend tomorrow. So with that, usually we usually profess that even when the market's moving sideways, you're going to find some good bullish charts, and you're going to find some good bearish charts. Notice and the airlines today were moving up for some reason. A couple good airline charts is Save, Spirit Airlines, and Southwest. Somebody was asking today, why are the airlines moving positive? And the answer is, I have no earthly idea. Doug, if your audio is cutting in and out, you might want to log off and log back on and see if you can get a better connection. So when we can analyze with a good degree of probability which way something is moving, at least we know we've got the prospects of being in the right place at the right time. Here's Alaska Air, and here's Hawaiian Air, all having good probabilities that there's their Morningstar signal closing above the T-line. Where's the next likely target? Probably back up to the top of the trend channel. So essentially what we're trying to find on the bullish side is which charts look good. Here's Array, one of the biotechs. Now the biotechs picked up steam today for some reason. So notice what this one has done. The big breakout moved sideways until came right smack dab to the T-line. Left-right combo. If it opens positive, good prospect that we could be in another wave of that magnitude. I'm just going through a few of now there are only a few tonight of good bullish charts. CZZ, still in an uptrend. FDP, nice big fry pan bottom. And this is why we always tell people, when you're in a chart, if it closes below the T-line, close it out. Because anytime you see it close below the T-line, the probabilities are that it's going to head lower. So that's kind of illustrated in this chart right here. EFII, nice steady uptrend until you close below the T-line and then slam. They've taken it down hard. So right now, with the market kind of soggy, got a lot of charts that are really selling off hard. This one is already gone, but you can see what happened once they closed it below the T-line. That's why you want to be out of a bullish trade. The T-line is the 8 exponential moving average. We call it the T-line because there's a very simple concept using candlestick signals. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see that candlestick sell signal and a close back below the T-line. With the caveat that the further away you move from the T-line, the higher the probability they're going to come back and test it. So that makes any sell signal, when you start moving away from the T-line, that much more relevant. So anytime, and again, because of the graphics of candlesticks, this is Crayer research. Notice what happened when it came up and hit the 50. Left-right combo, bearish engulfing. Little flutter kicker to the downside. The T-line is the 8 exponential moving average. I should have explained the T-line a little bit more. You can put the T-line on your chart just like you would put the 50. You can put it on anywhere. It's just like putting on a simple moving average. Now, the reason I guess I better qualify this. On our charts, we've got the 200, the 50, and the 20 simple moving averages. And the reason we have those on our charts is because every major money manager around the world makes their decision about their portfolio based upon those moving averages. So they act like magnets or targets. The benefit we have with candlesticks is we can see exactly what their decisions are at those levels. The T-line is the 8 exponential moving average. Nobody has those on their charts, so it doesn't act like a magnet. However, because it works so well, as far as showing you when a trend is in progress, as long as it stays above the T-line, you can stay long until you see a sell signal and a close below the T-line. Because it is not acting like a magnet like the other moving averages, it's kind of like a Fibonacci number, a natural support and resistance level. So the concept or the combination of candlestick signals, which are the graphic depiction of what's going on in human nature, and the T-line, which is a natural support and resistance level, makes it a very strong combination. Remember, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. That's what the graphics of candlestick signals are telling you. Do you think the presidential election has anything to do with the sideways moving about? Probably. But I'm not trying to analyze why it's going sideways, because that doesn't make me any money analyzing why it's going sideways. What I want to analyze is what is it doing so I can make money based upon that. Yes, the 34 is also another moving average that you can use. It's used a little bit more commonly. I don't use it all that much because I depend more on the signals themselves. So when I'm looking at a situation, my number one criteria is the signal. Then everything else is a confirming indicator. My confirming indicators are, where are the stochastics? My stochastics are set at 1233. And where are we compared to the other moving averages, and especially the T-line? That combination gives you high probabilities of being in the right trade at the right time or the right direction at the right time. So a few of the short situations, again, there is a doji gap down in MGYN, so we're staying short on this. And how long do we stay short? Well, we're not even into the oversold area yet. We'll stay short until we see a candlestick buy signal and a close back up above the T-line. So you can put the T-line on any chart, just put it in just like you would any other moving average. They're going to ask you whether it's simple or exponential. You just put in 8 exponential. That becomes your T-line. Yes, most moving averages on all the charting services can easily be customized. So we recommended going short on MOS today, MOS. And the reason for that is, notice how it was rolling over, failed at the 20, closed back below the T-line, was right here on a support level. If it opened lower, what was it telling us about the support level? It wasn't there. What was it telling us about our patterns? It was probably a bearish J-hook pattern, which tells us that if this is wave 1, wave 3 is going to be the same magnitude. Oh, the flutter kicker, I'm sorry. Which one were we looking at? Cray. A flutter kicker, the most powerful signal in candlesticks is the kicker signal. And a kicker signal is, I'll have to show you a kicker signal on another chart. Kicker signals when they open it here and close it here. That's what creates the dark candle. The next day they gap it up at or above the previous day's open and go the opposite direction. Essentially, investor sentiment has been kicked in the opposite direction. That's a kicker signal. A flutter kicker signal is basically the same thing, except you have a bullish candle. In this case, this is a bearish flutter kicker. The next day they gap it down, but they do a doji. They gapped it down below the previous day's open. See if I can make this bigger yet. And then open it lower. Remember our simple rule of the doji? It's going to move in the direction of how they move or open after the doji. There's your, they moved it this way, in this direction, to the downside. So basically, if you took out this little flutter, you've got a kicker signal, which is one of your strongest signals. All right, so there's a bunch of good shorts right now, much better shorts than longs. Here's AAOI. First target, I would suspect, would be back to the 50-day moving average. in the chat room this morning. They identified this one, the same chart as MOS. Rolled over, opened lower, gap down. We've got wave 1, wave 2, high probability wave 3 will be a pretty strong down move. I'm going to go through just a few more of the good bearish charts. As this one opens and trades below the 50, this is Williams Company. This could go lower. New Link. Yeah, notice where this failed. There's their bearish Harami, telling you the buying has stopped. Stochastics in the overbought area. Now you've got your doji sandwich. Doji sandwich is like a bullish or a bearish flutter ticker, except this candle is red. Then they have a doji. And this candle is usually the same magnitude as this candle right here. I can make this bigger. With a doji kind of sandwiched in between. What that implies is that there's going to be more downside. Moni, in our members area, we have a chat room that's open all day long. We've usually got 120, 150 people in there, depending on the day. Got plenty of traders have been using candlesticks for years that come up with very good buy and sell signals. And it's a place where if you're learning candlesticks, you can ask questions and kind of learn the process a heck of a lot faster than trying to learn it on your own. So with this failure right here, that tells me they've got a good possibility they could be taking it down. Next level could be down here at the 50-day moving average, which 3 points on a $15 stock. Is that a little over 20%? Dana Auto Parts. There's your doji gap down. You can see how it was rolling over. There's a good possibility. Now, remember, prices move because of investor sentiment. When they start getting fear or start selling off, they usually sell them off pretty hard. And that gap down is a good indication they're trying to get out of that position with great enthusiasm. So knowing what your signals are, there's your big evening star signal right smack dab at the 50. Gap down today. Where's your next logical target? You could probably draw a line down through the bottom here and have about a 30% move to the downside. HAR. Again, the doji gap down. Doji gap down. If it breaks this level, I got a strong down move. And CHFC, another one that had a bearish engulfing signal, gap down, and notice where it closed today, right on this support level. If they break this level, what's your next likely target? Right down here to the 200. Now that's just a target. That says, all right, is this worth trading? Can I get a 12% move to the downside on this? Or if I'm buying puts, is it worthwhile? So that's why we use different option strategies, which is Mark is going to go into. Right now, I'm using the spreads because we're within 2 weeks. We've got the October spreads expire not tomorrow, but next Friday. So the economics or the risk factor of a spread becomes that much greater. Look at Amazon. Amazon was down pretty hard today, but came back up. If it opens lower, it's telling us they're going down further, probably down to the 50 potentially. Now, when I'm looking at any trade setup, I want to know where is it going and how fast will it get there. And if I'm trading options, what is my time frame for getting there? So I put every target I can think of. In this case, I'm looking at the Fibonacci retracement numbers. Tells me they could come back here to the 812 just on the first target of your 38% retracement, 50%, and possibly all the way down to the 50, which would coincide with the 61% retracement. So that tells me, all right, I could either buy puts, but I've only got 6 trading days before expiration. What makes the most sense? Well, instead of buying puts outright, it makes a lot more sense. In this case, we're looking at the 825s, where you buy the 825 put and you sell the 815 put, and that net is $3.43, which essentially says if this stock, or if Amazon comes down to 815 by next Friday, that means my $3.40 goes to $10. The difference between the 25 and the 825 and the 815. If I want to be a little bit more risk taking, I might buy the 822.50s and sell the 812.50s for $3.20. If it comes back below this level by expiration date, that 320 goes to $10. So again, a little over tripling your money on some of these, or right about tripling your money. Now, there's others that you can take a look at. For example, XPO looks like it could drop pretty hard back down to this support level over the next week. So I might buy the October 35 puts and buy back the October 32s, which would be 75 cents. 75 cents, if it goes to 32 or below, that 75 cents quadruples to $3. So the spreads make a lot more sense. And depending on how much risk you want to take on a spread, like on Yelp, you can see how it's broken the 50. It could go a lot lower. Might take a look at buying the 36 puts and selling the 33 puts, right here, for a net of 40 cents. But if it goes down to 33 or below, your 40 cents now turns into $3, or some big returns. Let's see. I'm not going to take a look. Do you ever sell puts and calls? Yes, but I'm usually doing, which would create kind of credit spreads. I usually do the credit spreads 1 week before expiration. And the reason for that is usually you can determine the direction of a trend, and that it's not probably going to change all that much between now and, say, the end of the week. So the returns are much smaller, but the probabilities of making money with those spreads, because you're selling the premiums, is that much greater. Slow stochastics. Again, we're using stochastics to pretty much tell us where are we as far as the trend. Obviously, we aren't going to be buying a candlestick buy signal in the overbought condition, or a sell signal in the oversold condition doesn't mean that much. And when it goes against you, again, you've sold the spread, so you put money in your pocket, but part of that spread is the protection on the other side that if it went against you, at least you're protected by what the amount of that spread is. And I'll see if Mark is going to go more into that. I'm just going to do BABA, because BABA, if it opens lower tomorrow, as you can see, it broke the trend channel. Now I have to see whether it's going to come down through the 50. So with that, I've already taken up too much time. We've got Mark Sebastian here with us tonight, who also has got excellent trading strategies for options. So what we're going to do is I'm going to shut off my screens and let Mark bring his screens up, and he's going to give us kind of a demonstration on
Hey, John, Steve.
Strategies. Good, Mark.
Hey,
welcome
Steve,
to the Candlestick Forum. Good.
Oh, it's great to be here. Always a pleasure. Let me get my screen sharing going, and then we'll be on our way.
All right.
Hello,
We're gonna
all.
have to give Rick a minute to quit.
There we go. All
Format.
right, before it gets. So what we've done is I did create a little presentation. It's got some pretty good stuff in it. And I'm going to talk about kind of how some really interesting ways I think to recreate trades that can replace stock. And I'm going to talk about a couple alternatives to structuring. And then I'm also going to talk about a couple of trades that hands, and we'll have a chance to answer some questions, as well as I know Steve didn't hit at this, but he and I worked together on a little package that we think you guys are going to be kind of excited for. And so let's talk about things here. We're going to talk about directional trading with options, and that is me, that good-looking young chap from 5 years ago before life hit him. No, I'm kidding. But before I begin, let me remind everybody this is for educational purposes only. None of this should be considered investment advice. Options have risk. Consult your financial professional. But let me tell you about me. I was a floor trader for about a decade. I was a trader on the CBOE in Chicago and the American Stock Exchange in New York. After that, I left and started Option Pit. We are an education and consulting firm. On the consulting side, I will work with institutions and trading firms, helping them implement, optimize, and stress test option strategies. So right now I'm actually helping a hedge fund actually build out their entire infrastructure. Then on the retail side, with retail traders, I try and teach them the same approaches to trading that taught me how to trade. And that's really what we do. So the same techniques and approaches that I learned to trade, that really were used to teach me, I try and teach you guys. So when I was 21, some few floor traders spent a year teaching me how to trade. I do the same with you guys. So we're going to talk about basic buy-sell decisions, a little bit about strike selection, some combinations of buy and sell, and I'm going to talk about some trade structure. We're actually not going to do the VIX thing. Options and stocks. So the key to trading options for direction is to understand correlation. Right? So correlation means how one instrument moves with another. And a correlation of one means the two instruments will move perfectly together. So, for instance, SPY correlates almost 1-to-1 with the S&P 500. The correlation of an option will never be greater or less than 1 or -1. All right? And then I want to talk about the term delta. And delta is the option trader term for correlation. It can also be called slope. And people say, well, why do you use the term delta? And the answer is it's Greek, and so smart people like Greek for some reason. And two, I think it sounds cooler than correlation. So there are some things that affect delta, how that the correlation. And it's passage of time. As time passes on an option, its correlation changes. As the underlying price changes, that also affects the correlation of an option. And then, of course, one important factor, which is volatility. So an option with a delta of 0.6, all right, a 60 delta option, we would call it, will make 60 cents for every dollar the underlying rallies. It will lose 60 cents for every dollar the underlying falls. That is how these things work. Right? So what makes it so difficult is that it changes. Right? It's not like buying stock. I buy 100 shares of stock. In a month, it will correlate to the underlying. In a year, it'll correlate to the underlying exactly the same way. Options don't work that way. And that's why it's so important to structure them right, which is what we're talking about. And the one that really throws guys off is volatility. And if you combine candlesticks and a really strong technical understanding of markets, a strong understanding of volatility, you can develop option trades that can put you in a tremendous advantage. So this is kind of a chart of how an options price will move with the price in the underlying. The green kind of represents underlying price. The blue line represents a call option and how it tends to kind of move with the underlying. So at the strike price, it's moving about 50 cents for every dollar the underlying moves. And then as it crosses its cost, that movement gets exponential until it essentially moves 1-to-1 with the underlying. So this is one that I get, is people say, hey, I bought these calls right before earnings, and the stock is way higher, but I'm not making any money. You guys are cheating me. Professional traders are stealing my money. And the answer is no. Professional traders are not stealing your money. Something changed, and it's called volatility. The expectations of movement changed. All right? The thing to recognize is stock is ownership. Options are insurance on ownership. When you trade an option, you're trading an insurance contract. And so that insurance value changes after earnings relative to before. And if you aren't prepared for that, you're not going to make money trading earnings. So the thing to remember is that the Greeks, including delta, are modeled risk. And they're based on inputs in the model. All right? And so the Greeks, of which delta is one of them, aren't a hard number. They're an output. You guys ever heard the term garbage in, garbage out? All right? You hear the term garbage in, garbage out. Well, if you put a junky volatility into your pricing model, it's going to give you a junky delta. And that's why it can be difficult to trade before earnings. Options can be kind of a crapshoot. So since delta can change and it's modeled risk, picking the right option for the directional opinion is key. Should it be bought or sold, in the money, out of the money, or at the money? It all depends on the implied volatility, right, and how you structure your trade. So what makes trading volatility different than trading a stock? Right? I buy Apple, it could go up forever. Right? So here's a chart of Apple. All right? Is there a mean price? Maybe in the near term, if you're looking at exponential moving averages and things like that, there may be near-term mean reversion. But is there long-term mean reversion in stocks? No. There is not long-term mean reversion in stocks. Simply doesn't exist. Meanwhile, take a look. This is the VXAPL. That gray line is the 200-day moving average. That thing is about flat as a pancake. So the thing to understand is if you look at volatility and know where it is before you enter your trade, it'll make a big difference in your decision. If I think Apple's going to go higher, and the underlying's here, what do I do? And volatility. Let me get pen. So if volatility's here, what do I want to do? What if volatility's up here or here? What if it's down here? Well, we're going to talk about it. And it's like clockwork, folks. All right? So stocks can go anywhere and stay there. Volatility can go anywhere. It can go to any level it wants to. It won't stay there. It will not stay there. So understand this will help with buy-sell decisions. Then I'm going to quickly go through deciding between a buy and a sell, and then I want to show you some trade structures that I think are going to change how you develop a trade. So there's always some nuance to guessing, all right, low versus high, all right. When is volatility, all right, low, and when is it high? And it really involves understanding where the IV is, the implied volatility, where the option price is, relative to the momentum. How much is the underlying moving around? So take a look here. This is a chart of Netflix. All right. The blue line represents historical volatility. The red line is implied volatility. So this is a 6-month chart of Netflix. So relative to where Netflix is, what is going on with implied volatility? The answer is it's the lowest price in 6 months. Meanwhile, what has happened with historical volatility? It's actually inching its way higher. So is this a case where I'd be interested in buying or selling? Here's what I'll say is, I would interpret this as low implied volatility. All right, what about SPY? All right. Well, the implied volatility is relatively high relative to, the last couple of months, but not the last 6 months. Meanwhile, what's going on here? Movement is rallying. So volatility is relatively low. It's where it's been in the last 6 months. It's higher than here, but it's not super crazy high. Meanwhile, realized volatility is climbing. That's premium I want to own. And we'll look at some stuff in a live environment. Don't worry. So so the key is, if the momentum eclipses where the implied volatility is, or the direction, you probably want to own options, not be short them. So like low IV, high IV is a bit more of an art and a science. All right, there's art to this in science. So where has high been in the stock historically? Where is the VIX? All right, is the underlying moving? Will it continue to move? Relative to the movement, how much slack is there in an IV drop? So here's Apple. Over relative to where it's been, vol's kind of high. And even though there's a little bit of a climb in movement, it's still way trading at a huge premium. Implied volatility is probably a little high here. And no, there's no earnings. Now here's one that's a little more clear. Here's Applied Materials. Yikes. Here is a case where even with earnings coming up, there might be a trade. All right? Because kind of implied volatility is so high. All right, so now, the final piece of volatility is skew. And skew is the relationship of puts to calls. All right, so supply and demand basically increases the value of puts and decreases the value of calls. Right? I mean, think about it. Everybody in the world is long the stock market. Right? Everybody in the world is looking to create income, so they sell calls. Everybody in the world is afraid of the market dropping, so they buy puts. So this need to hedge creates demand to sell calls and demand to buy out of the money puts. And thus options don't move uniformly across the curve, and thus most equities look like this. All right, if this is my at the money, as I go up, implied volatility is lower, and as I go down, implied volatility is higher. And this trade structure creates some really cool trades that once I show you this, you are never going to want to actually buy a stock again. You may want to short, but you're never going to want to buy it again. All right, so now what is steep and flat skew? When upside calls are priced at a really high IV and have a real value relative to at the money, call skew is steep. When downside puts are trading at a higher than normal IV relative to at the money, downside skew is steep. Flat is just the opposite. That's when upside or downside gets smashed. All right, so when downside gets really, really flat to the point it's about even with at the money, you want to back up the truck on puts. And when calls get bid, one of the real signs, I'll bet you this matches up with some, and this could actually be used as a confirming signal against some of the things that Steve uses, so like the T line, is when, especially on a bull run, when we see calls get bid to the point where they start to become as expensive as puts, that is almost always a sign of a top in the underlying. So now let's talk about buy-sell decisions and structure. So in general, an IV is low or in the near term and especially in the long term, you want to buy options. All right, when IV is high or normal. So when IV is at its mean, generally speaking, options should be sold. When IV is normal, options should be sold. When it's high, options should be sold. When it's low, options should be bought. The thing to remember is options are usually low more often than they're high. So it turns into a case where about 35 to 40% of the time options should be bought, 60% of the time options should be sold. So if you want to get long, you sell puts or buy calls. Let's talk about the mentality. And this will actually help you with, and I think this really works for candles. Because the thing I like about candles is that they can tell you, hey, I don't think, I mean, it's going to take not an act of God, but it's going to take something really drastic for this to go lower. Right? It might not go higher, but it's going to take something drastic for this to go lower. So when you're selling puts, the thing to remember is that puts are long delta and short vega. So you're hoping the stock moves higher and then the IV comes in. That volatility. What makes IV drop is movement dropping or the expectation of movement dropping. So when you sell a put, you're betting that the underlying isn't going to go down. You're actually not betting on a rally. And then I'm going to show you how to sell a put and bet on a rally at the end here. Here's a nice little JP Morgan. Bouncing around. I'm sure there's some great candle trades in there. I'm not a candle trader, folks, I'll be honest. But I'm sure if I showed this to Steve, he could tell me a bunch of things. But look at this. The implied volatility is really high. So guess what? Sell put. Watch it move. Sell the 55 put. You outperform buying the 57 call. Meanwhile, the long call is the opposite. You're actually betting that the underlying is going to move higher. You're looking for an increase in movement or an increase in expected movement. You're betting a stock is going to go higher. That's your breakout play. So this looks like a breakout. Implied volatility is low. Great, buy calls. This looks like and I guarantee this happens. This looks like a breakout, but I'm not sure, and implied volatility is high. Sell put. Alta is one of my favorites. Thank you. I mean, this one was like clockwork. I mean, you've got implied volatility at the lowest level of the year and a stock that just has momentum higher. Easiest call purchase in history. And Alta's one of those that just does that all the time. I love Alta. You want to know, and I'll tell you, especially with makeup and with clothing, I apply what's called the my wife test. And 2 weeks ago, Alta kind of getting trashed. I mean, have you guys looked at a chart of Alta lately? So Alta, bad earnings, getting trashed, and I'm talking about it with my wife, in and around, and look at where the implied vol goes, by the way, guys. So implied volatility, pretty low. And I'm listening to my wife go, I can't, and she literally said this, I can't go into that store without spending $100. And then I said, oh, I'm going to buy calls. So I bought some October calls, cashed out today on a 5 lot. Literally 5 calls. Doesn't always happen, but when it does, it's nice. All right, so like going long, when one wants to get short, if IV is high, you sell call spreads. And if IV is really low, you buy puts. IBM, I'll show you 2 IBM examples. I can show you a bunch. IBM, I could show you all of these in just IBM. IBM, vol high, sell call spread, sell call spread. Stock doesn't do anything, stock doesn't do anything. So now this is a historic one. This was the easy money. So IBM, terrible earnings, takes a ginormous dive. And continues lower, but they tank volatility at the same time. Easiest put purchase in history. All right, and I'm going to tell you one scan. I'm going to talk to you about some scans that we do, and that's one of them. So now let's talk about how you might build a trade that kind of volatility proofs your portfolio, or volatility proofs your trade. And the answer is using a risk reversal. So there is a significant advantage to using a risk reversal to trading the underlying itself, especially for something like candles. So let's talk about that. So what is a risk reversal? It is when you sell an out-of-the-money put and you buy an out-of-the-money call, and you're playing direction. Let's take a look at this. I sell Apple's trading 109. I buy a 113 call. I sell a 105 put. I collect between 3 and 8 cents. I get paid to go long. All right. We can look at one today in Apple. All right. Apple's on a breakout, right? Everybody loves Apple. Applied volatility is actually down. I mean, take a look here. Take a look at Apple. That sucker is high. Now, they've got earnings coming up. That's going to affect things. And get the options to show up. Come on. Let me look at another one. See if I can get the... There you go. I don't know why Apple's coming up slow. So Facebook, here's one. It's got earnings coming up end of the month. Implied volatility is really high, but I personally think it's gonna break out ahead of earnings, which are on the 2nd. All right. So the nice thing is, if I delve a little deeper, take a look. There is some cheap vol, 20% instead of 35. Well, if I look, is 20% cheap? That's a 1-year chart. Yes, 20% is cheap. Is 20% cheap? Here's a 2-year chart. Yes, 20% is cheap. All right. So what could I do? Well, Facebook is trading 127.80. Obviously, the market's been selling off. What if I sell the 125 put at 110? So that's going to be $3 out of the money. And then I can buy a call that's also $3 out of the money for 85 cents. I get paid 25 cents to be long. Let me show you what it looks like on a risk chart. So as you can see, it actually acts a lot like the stock. But if it doesn't do anything, instead of just my money wasting, it actually starts to make me a little money. And I have a cushion. This is a far better structure for a 1 week trade than owning the stock, because it actually pays. So because of Skew, there's often a value in trading a risk reversal. And those risk reversals are especially significant in SPY and SPX and other ETFs. If you are an ETF trader and you trade the stock, you are doing it wrong. You should be doing the risk reversal. A risk reversal involves the selling of that out-of-the-money put and buying the out-of-the-money call. And the spread has that credit. Bull risk reversals almost always trade for credit, and you win if nothing happens. You win if the stock drops a little, or rallies a little, and it acts like a normal stock on a major move. All right, so now let's talk about some ways to modify this trade that maybe are for those more retail trader-esque. All right, so what if you want to create income, you want limited downside risk, but you want unlimited upside potential? You guys want to trade like that? You want to create income, you want limited downside risk, and you want unlimited upside. All right? You basically want the world, is what you're telling me. Well, what if you sold a put spread and bought call? So Goldman, I sell the 55-65 call spread, put spread, and I buy a 180 call against it. Not so awful, huh? So on this 10-lot spread, you collect $1.55. Not per spread. Actually, I think it ends up being a quarter a spread, correct? Yeah. So a quarter a spread on 10 lots. So you make $250, or if the stock breaks out, you win big. That's what it looks like. Limited downside, unlimited upside. And what I love is if Goldman drops 10%, you lose $6,000 on your 10 lot. If it rallies 10%, you make $10,300. Tell me a stock trade that'll do that and create income. Doesn't exist. So use a risk reversal when one wants to take delivery. All right, you want more income. It does have a little more risk. If you're not afraid of delivery, or you really have a strong conviction, use the standard risk reversal. All right, if you're a really seasoned, straight-up stock trader, use the risk reversal. Super crazy skew, IV is somewhat low, you can use these. The modified risk reversal is when you don't want to pay for calls and you don't want to own the stock, all right, and you want to trade a flat skew. So now the final one is the credit spread kicker. And this is for all you credit spread traders. And I don't know why nobody ever thinks of this. I love credit spreads. All right? All right, I'm shocked people don't do this. Why didn't anybody think of this on their own? So you sell options when you think an underlying is not going to go down, but often when we think they aren't going to go down, they do go up. Credit spreads are great, but have no upside. So what if you just did it on a tiny ratio? What if you sold 10 and bought 1? What if you sold 10 and bought 1? So let me walk you through a little trade that we did that was this type of trade. We do these a ton. This is in our strategy letter. All right. We're pretty sure VXX was not going to go up. This was older. This is last year. All right. This is not the current November. All right. We were pretty sure that VXX was not going to go up. It's just a really clear example. We bought 1 VXX November 14 weekly 33.5 put for $3.45, and we sold 5 of the 35.38 call spreads at 34 cents. All right. So we actually paid a debit on this, but we used 1 to finance a little bit of the other. So the net result was we covered the 35.38 call spread for a nickel, and we covered the 33.5 put for $4.65. So we made $145 from the call spread and $100 from the put. Net, we made $245. All right. Full disclosure, this was a volatility hedge against a SPY straddle that also made money. All right, so now I'm going to show you a quick combo that I love involving volatility. So the SIBO disseminates all these VIX methodologies, and there are all these different ways of getting volatility. So what I want you to do is look for stocks that are a 52-week high and look for volatility that's at a 52-week low at the same time and buy the first call that's out of the money. And we have a real close relationship with LiveVol, which is owned by the SIBO. And if you go in their Pro Scanner, we actually have option pit scans, and this is one of the ones we have in there. So I'm just really kind of basically explaining the scan. And what you're doing is pulling up names where the volatility is at a 52-week or a low price, and the stock is at a 52-week high. If you do that and then you buy the first call out of the money, you will be a happy camper because it pays. Right? What ends up happening is so many people overwrite calls that those upside calls get too cheap. All right, so let's just take a mainstream stock. All right, like an Amazon. So Amazon is trading. Didn't look at today. I was actually trading today, so I was a little tied up. Amazon trading 830. All right. I'm a call overwriter. I sell the 850 call. All right. Amazon volatility is super low. Well, I buy, as Amazon rallies, all right, those guys that crush volatility by selling the 850 call probably don't want to lose their stock as the underlying rallies. And what will happen is it'll actually catapult the stock higher. We've seen that in the last few months with Alibaba on that crazy move. Apple did that. I mean, Apple was nuts. I mean, I was all over this one. I mean, they just absolutely crushed Apple vol on earnings. I mean, look at this. So Apple has great earnings. They destroy the implied volatility. It was at a one-year low. All I did was I pounded the table to buy calls. That worked pretty well. So here's a more recent one. Here's USO. USO, the vol's been really high all year. Well, the stock's was climbing. Not quite at a 52-week high, because you had some of the garbage from before oil completely fell apart. But really, if you're looking at from about Jan on, you have the stock right near its highs and volatility right near its lows. So you had a really good opportunity to buy here, and that gets you in here. Nice little run. All right, there are some cool things you can do when it's the other way. So the other one, and I actually like this. This one's actually even better. So when implied volatility hits a 52-week low and the stock hits a 52-week low at the same time, that stock is going to the floor. They're going to kill it. By the second put out of the money, you are going to do really well with that. Why does that happen? What that tells you is the stock is so bad. So here's GLD. This was one I actually got wrong. I was looking and said, hey, buy, call. I think, look at how low volatility is and look at what's been going on with the stock. Well, what I didn't realize is, oh, you know what? We're right at a level where this thing it's gone lower. This isn't quite the same rule. So it's been climbing lower and it's bouncing off that level. And look at where the implied volatility is. My dummy self said, oh, you know, it's bounced off here. What I should have gone is gone, Ooh, look at that low implied volatility. Neither bought straddles or bought puts. In our strategy letter, we did straddles. In my PA, I did calls. Whoops. Win some, lose some. But I'll show you that, and then I'll take some questions, and I'll talk about what our deal is, but you can see, you don't get a lot of these, but when you do, they can be really, really good. Had one work really well in Skechers recently. I mean, look at this. So you could buy vol here and basically write it down to here. How's that? Didn't even have to deal with earnings. All right, so in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for every trade, and you have to understand the sensitivity and use IV and directional moves together. Now, I want everybody to go to stephenbigalow.com/candle options, because Steve and I have put together something pretty incredible. All right. So Steve's always looking to kind of add the most edge and kind of put things together. And when you combine a really strong edge in picking direction and with a really strong edge in volatility and buying in the money and at the money and out of the money, structuring your whole trade, well, guess what? This is what you get. So we put together a really good product. So you go to stephenbigalow.com/candle options. You get a 6-month membership to Steve's weekly options edge service. You get 12 training webinars, 25 weekly option edge advisory selections, a once-a-month live webinar for weekly option edge members only, and private weekly option edge live trading room. All right, you get some projecting price targets, some trading videos, all sorts of how you structure your trade. Where's this going to go? So I think it's going to go higher. Easy. How much higher? That's what you get out of this. And it's just awesome. All right? And this is a really valuable product. This thing is like, that by itself is well over $2,000 bucks. All right, I think when we added up, it was like $2,500. Now, let's talk about what you get from me. You get my Option Pit Live service for 6 months. So what does that get? You get my chat service, which is going to give you access to myself, Andrew, who's my number 2, and a bunch of my great traders. All right, between Andrew and myself, we're on for up to 4 hours a day, typically, at least two or 3. So we're going to give you ideas every morning. All right, we're going to give you trade management suggestions. We're going to be there for feedback. Just incredible idea generation. All right, you're going to access to our pit report every day. Andrew and I record our pit report. We often, 3 to 4 days a week, develop a trade idea that we want to do that may be speculative, that may be income producing. All right, so we're talking some income trades and speculative trades, directional trades, if you will. All right, we then put that into our strategy letter. The strategy letter follows all the trades that we execute, manages them, and executes them, and keeps track of the P&L. All right, it's for educational purposes only, but it does. And you can ask questions. We'll pick subjects to discuss that you ask. All right, so it's pretty awesome. You get actionable ideas, daily trade adjustments, things like long option and gamma scalping, and we also do some pairs trading. It's pretty awesome. In addition, to make sure that you really understand what we're doing in our chat room, we're going to give you the Beginner Boot Camp, which is a 9+ hour recording, all right, of our live Beginner Boot Camp that we did. basics of option pricing, mastering of buying and selling, learning to sell options effectively, using them to generate income, trading credit spreads, debit spreads, wheel trading, trading options for direction like a professional. All right, it'll teach you how to execute and produce income. When you're done with our boot camp, you will have a really clear understanding of how to get your way through our strategy letter and our OptionPit Live service, which can be a little much for some beginners, which is why we have this awesome beginner boot camp. Plus, this is the final thing. This is our kind of throw-in. You get exit points. All right, exit points provides just some amazing trade ideas. All right, you're going to get a bunch of different little trade alerts on NASDAQ, gold, silver, all sorts of stuff. Where it'll say, hey, this looks like it makes sense to get in, this makes sense to get out. Then you use candles to confirm, and you use volatility to develop the trade. All right, or you use candles to find your trade, then you use exit points to confirm. You use volatility to structure trade. You use volatility to develop the trade idea, candles to confirm, exit points to tell you, hey, maybe it's time to get out. I mean, this is just some incredible stuff. When you add it all together, it's worth over $6,000, $1,997. All right, it is a special training program. You get me, that handsome young man, and Steve, who's also handsome and just a really great guy. And I'm actually not that young anymore. All right, and you're getting guys that, and especially me, you're getting guys that really work at a professional level, right? I am managing a hedge fund in between working with you and working with other funds, right? People say, well, Mark, why do you have this retail business? The hedge fund consulting business can be a little chunky, folks, and the retail business is a little smoother, and the same thing with trading. It can be a little chunky. But I really do enjoy both ends. But I love working with retail investors and traders, and so does Steve. And with that, I think we'll take some questions. You go to optionpit.com/candle, and I can take some questions. No, because I don't. Is that a conflict of interest to run money? No. Because I would never tell you to do something that's against my, I wouldn't be, I'm not going to be telling you something and then trading on the other side. And we always kind of tell you what we're doing. Yeah, we do all sorts of different types of scans. How did I get floor traders to teach me how to trade? That's a good question. When I got hired out of school, I spent a year basically slaving. I had a 4-year college degree, and my job was collecting lunch for a bunch of 25-year-olds and 30-year-olds. So that was my job. LiveVol is free if you open a trade account, and you can find IV and HV in TradeStation, but that would be a good question for TradeStation. Mark, does IV really matter on weekly credit spreads? For sure. One, it'll get you out of the way. And two, it may tell you that, there's a massive amount of implied volatility in that final week. If you look at how options decay, all right, if you look how options decay, they lose a ton of value in the final week, and that is really dependent. All right, that is really dependent on where the implied volatility. Exit points is an kind of an entry and exit service. So why is that? Can you explain a little more about the setup where low IV and falling price can precede a lower price? Yeah, you know what it is that when an underlying is dropping fast, if you look at what happened today, right? I mean, take a look at how VIX and the S&P work. Right? You know, when the S&P is dropping, vol goes up. All right, why? Because people are racing to hedge. All right? And when people aren't hedging a stock that is dropping, you know what they're doing instead? Hey, if you want to pay for a turn, put money in a fund. That's what you do. Nothing is guaranteed to make you a winner. Yeah, everybody's selling their stock. That's why the vol tanks. How do you get live vol? Email, if you're a client of mine, I have some very good special pricing, but generally you open a brokerage account and you can you open a brokerage account with Lightspeed and they'll give you the application for free if you trade. Yeah, ID really matters. Anybody that tells you don't need to understand implied volatility and you're going to be really active, you're leaving money on the table. That's like saying you're going to defend. That's like going in a court without a lawyer. Can you win? Maybe, but does it help to have a lawyer? Hey, there's a reason why they're expensive. It's because they're worth it. All right, so you go to optionpit.com, you go to stephenbigalow.com/candle options. I've seen your program at Iron Butterflies, but have you ever done anything on S&P strangles? Yeah, I have. I mean, not in terms. I mean, there's so many different ways to trade strangles. Here's what I'll say is, it's not as simple as people put it out there. There was a strangle trader named Karen the Super Trader who's going to go to jail because she lied and didn't understand the risk associated with strangles. Generally speaking, the same conditions that make strangles really nice is what makes condors. Yeah, she's going to go to jail because she lied about her returns. I don't know if you heard, she stole something like $6 million or something like that. So it's never that easy. And anybody that we're not that way. My mother said if you can't say anything nice. With the risk reversal trade, 52-week high, low vol, what do you do if vol does move? Well, vol moves higher. Typically what's going to happen is, so if vol moves higher, what's going to happen? Probably then either the call that you bought is going to make money because the implied volatility increased, or the vol moved higher because the stock started moving. What if vol doesn't move? Well, that's when it becomes a directional trade. Typically, you should, if you're buying these about 45 days out, you give them a week to work. If they much beyond that, maybe 2, then you're probably done. You're welcome. Any other questions for myself? All right, cool. Well, everybody, take advantage of this great offer. It's going to be it's a pretty sweet do. And I think you guys are going to be pretty happy with what you get out of it.
Thank you,
All right.
Mark.
Hey,
Everybody,
thank you, Steve.
Take a look at this program. The price has nothing to do with the value. You're going to get way more than your money's worth at that price. So obviously, this is for the person that is very serious about consistently sitting here at the screen and making money with options. So with that, Mark, thank you very much. Very good information.